Hey everyone, welcome to the KE Report, a special Sunday daily editorial. Very excited to announce that we are chatting again with Randy Smallwood. Randy is the president and CEO of Wheaton Precious Metals. Company is traded on the TSX, the NYSE, and the London Exchange under the symbol WPM. Now, Randy, Q1 earnings for the company are coming out in early May. So what I really wanted to do here is lay the groundwork for what 2025 looks like for the company in terms of your setup. You ended last year, 2024, with the cash in the bank of $829 million, no debt. This sets you up, I guess, to make some more deals, continue to grow the overall portfolio that the company has of streaming assets. Now, again, you're very focused on precious metals here, but in terms of a 2025 outlook for growth, tacking on to what already was a strong 2024, what insights can you give us at a high level, please?
Well, first off, Corey, thanks for the invite. Always enjoy coming on and chatting with you and your team. Very exciting times for Wheaton. 2024, as you mentioned, was a good, strong year. Our fourth quarter had some record production from some of our flagship assets and saw continued strength all the way through. So outperformed our 2024 guidance by about 15%, which was nice. We're kicking off 2025 as representing really the first year of an extended growth cycle, where really over the next 7 years, we're going to be climbing by about 60% in terms of production, with a whole bunch of new mines coming on, a whole bunch of our existing mines that are going through expansions and hitting higher grade phases. But a lot of the investments that we've been making over the last 5-6 years, we've been probably the most active of the precious metal streamers. A lot of those investments are coming into production now over the next 2 or 3 years. And so we've got a really good growth cycle coming out with 4 new mines in 2025 that'll be delivering metal to us on a go-forward basis. And so 2025 is shaping up very well. We are, again, entirely focused on precious metals. And just with that growth cycle coming forward, I don't think we could have timed it better in terms of the current market, and to have really a good kickoff, 40% in the next 5 years, and as I said, 60% in the next 7 years. And our objective is to get this company up over 1 million gold equivalent ounces per year of production, which well beyond anything that any streaming or royalty company has ever been at. And again, focused entirely on the precious metal side. So a really exciting position and a really strong balance sheet that can help not only fund that growth, but also continue to look for more opportunities to continue that growth cycle going forward.
Yeah, Randy, it's such an exciting time in the sector right now where a lot of companies can advance those projects, get them into production, or expand production at existing mines. And it's the beauty of the streaming model where you've got a set price on these metals regardless of what they do. But if they can expand production or move forward production, it's just icing on the cake for a streaming company. Maybe talk about 1 or 2 of the key projects that you think are going to move the needle in 2025 as they come into production or as they grow production.
Well, first off, Salobo, the Phase 3 expansion, it is our flagship asset, so you have to talk about that. The new management team's in there. The fourth quarter is running at outperforming in terms of its own capacity, and so they've satisfied their second phase of the expansion payment, and Salobo is actually doing very well for us, and pretty excited about that. We hear Vale talking about a Phase 3.5, i.e. another phase of expansion. It probably won't be to the full level. They are studying an additional 6 million tons per year of capacity. They haven't committed to it yet, but this is why we invest into assets like this. They're delivering great margins for us, but also very great margins for our operating partners. And Vale continues to reinvest into Salobo. Antamina is our second largest asset, and it's going to see significantly higher grades. They've shifted the in-pit crusher, or they're in the process of shifting it, and so they're accessing some stuff that was locked out underneath some higher grade materials. And so we're going to see a healthy bump in silver production out of Antamina over the next few years, probably upwards of 40 to 50% increase from Antamina. So our 2 top assets have got good growth sort of built into it. Salobo running at its new levels, and Antamina itself. But on the new asset front, perhaps most excited for this year is the Blackwater project with Artemis Gold. Stephen Dean and the team there they've already had their first gold production. The asset's up and running and doing well. We're expecting to see about probably about 15 to 20,000 ounces this year, but its run rate should be around 30,000. Although Stephen and his team are talking about moving forward their own expansion and bringing in the phase 2 of Blackwater even earlier. And so we could see that even bump up higher. So we're pretty excited about that. Of course, Clive Johnson at the B2 team, they got the Goose project coming on. He's committed to pouring gold sometime in June, so we'll start seeing a bit of production from there. The Waterton group is getting Mineral Park up and running. And then, the last project that I'm really excited about, because it's only just, a start, but it's the Platreef project with Ivanhoe. They expect to be producing metal by the end of this year. It's going to be low. They're only, for the first couple of years here, they're still doing underground development in terms of ramping up that full production level. So it's only going to be running at a little bit over 1 million tons per year. But Ivanhoe has been very clear about moving this forward up to that full 10.7 million tons of capacity by 2029. And so we do see some really good upside on that. Keep in mind, it's mainly a platinum and palladium mine, but we get the bulk of our revenue comes from gold as a byproduct production, about 2/3, maybe even 75% now with the way gold's performed. 75% of our revenue from the Platreef stream is gold focused, and so it'll do well. But Platreef is going to be a disruptor in the space. It's such a low cost, both from a cost and a safety perspective. Within South Africa, it's going to be one of the safest mechanized operations, bulk mining at depth. It's 1,000 meters down or 800 and some odd meters down. But when that asset gets up and running, it's going to represent the entire lowest quartile of the South African PGM space. And so this is a disruptor in the space, and I'm really excited to see this start to produce metal this year and ramp up over the next 4 or 5 years. And so pretty exciting to see new production coming on from 4 new mines this year.
Randy, I want you to explain the leverage that the company gets to see in this environment where we are seeing higher metals prices. We had Newmont's earnings out this last week, and look, their earnings are very strong, driven a lot, really exclusively by higher metals prices, because we are seeing production a little bit down from the quarter of last year. You brought up something to us that at these higher metals prices, some of these companies can bring in some lower grade material because now it is economic. But because you're a streamer, the leverage that Wheaton gets from your deals, how can you break it down? Is it just through higher production? Is it the higher margins that these companies are seeing? Where does Wheaton really benefit in this mix?
Well, and Corey, the biggest challenge the mining industry has is that when you see commodity prices climb, the costs will always chase it because the lower grade, not so economic material becomes more economic, becomes more attractive. And it's really tough because you're dealing with mills and crushing plants and everything that's only got a set capacity. And so if you're pushing lower grade material through there, you're just going to wind up producing less metal for the same cost, ultimately resulting in a higher cost per ounce, and your production numbers on an annual basis will be down. But you are bringing more metal into the financial, into the mine's plan itself, and so there is a net gain. It's just what you're doing is sort of growing these ore bodies, and we really haven't seen a lot of impact from that yet because a lot of the companies are still taking a relatively conservative approach with respect to how they develop their mine plans. But it is something that really gives the advantage to the streaming company. And I would say the streaming company, even over the royalty company, because a streamer has a base production cost on a per ounce basis. We make a production payment typically around $450 to $500 per ounce. And that does give us leverage. A royalty company doesn't have that production payment, and so we'll only gain whatever comes out of the actual commodity price itself. We get some leverage off our production payment. But then, Corey, as you say, we also get the benefit of that extra production, that lower grade material coming into the production plan. We get the benefit of that gold again at the same costs as defined in the contract. And so we don't suffer from inflationary pressures, and we don't suffer from the higher commodity prices pushing lower grade material through the mill and driving up those costs. What'll happen to us is we end up with ultimately more metal. It might mean that we see a little bit less metal from some of these operations as they process lower grade material, but it's only because we've added this extra metal to the overall production plan. And so I think the streaming company, the pure streaming company, is in the best position to maximize returns on a strong gold market.
Yeah, Randy, it's a good distinction on the advantages of the streams even over royalties, but definitely the advantage you have by having that fixed cost that you've already paid in so that your margins are getting better with the higher and higher metals price. And irrespective of what the costs are for the underlying operator. But the other thing that we're seeing a lot of is companies that want to move projects forward where they're a lot more open to doing a stream now. Maybe gold or silver as a non-core metal for them, like you were mentioning with Platreef. So they're maybe open to that as part of the capital stack, where in the past they wanted to do everything with just debt or equity. And you were mentioning a good case study would be what happened with Montage and the Kone project, and how they were open to, using streaming as the main way to fund the project moving forward. Maybe break down the environment that you see as far as companies being open to streams as part of their capital stack.
Well, look, the only type of deals that we're interested in doing are deals that are positive for all parties, for all the stakeholders in it. And so the operator's got to be happy with the transaction, and for us, we don't want to squeeze our way into anything. So some people might get concerned about being entirely wed to a stream itself on a go-forward basis. But I think the structure that we did with Montage Gold was one that actually really captures it quite well. And here you've got a company, a single asset development company run by a strong management team and some very, very significant shareholders. And they're trying to build a mine that's going to ultimately produce, well, they're building a mine, it's already in construction, that's ultimately going to produce about 300,000 ounces a year. Their cash costs should be well below $1,000 an ounce. So if you look in today's price environment, that tells me that they're going to have operating margins, just pure operating margins, not counting any debt repayment or anything like that, operating margins of close to 70%. So there's plenty of capacity for them to fund 20% to a streaming company. And oh, by the way, there is no debt repayment. We've funded the entire project through the streaming transaction we set up. It's incredibly attractive for them. They're going to turn on the switch, and they're hoping to be up and running by the end of 2026, early 2027. They're going to turn on the switch and be producing 300,000 ounces a year at less than $1,000 an ounce. And the only cost they're going to have is that $1,000 an ounce and 20% of whatever gold's coming back to Wheaton. And so they're in a great position to start off with and build from. And so it's a deal structure that has really caught the attention of the market. We've had a number of other single asset development companies coming forward looking for proposals along the same lines. Clearly it needs to be a high margin asset, which, the Kone project definitely satisfies that criteria, for us to consider going down this path. But, who knows, maybe the streamers will be the ultimate, funders in terms of financing some of these mines going forward. And it's a win-win situation for their side in terms of not having any project debt and basically running at a healthy profit right from year one and not having to deal with banks. We, of course, as a streamer, will share some of that project production risk as it goes forward. So we're much more supportive than your average bank when it comes to that, and especially the type of banks that would be lending to a single asset development company, much, much more supportive. And so it's incredibly exciting. It has opened up a lot of opportunities. Now, one of the challenges, of course, is the byproduct versus the core product. And I hate to say it, but right now we're not seeing a lot of base metal projects or even silver projects moving forward. Prices just aren't high enough in the copper space and the lead zinc space and the nickel space to justify big capital commitments. And so most of what we're seeing are gold projects. And I don't have a problem with that. If they're high margin assets, we're happy to take our share of that gold and keep on doing that. But we do keep our eyes and ears open for those big copper projects. We just need a bit stronger copper market to support those investment decisions.
Yeah, that's so true. But pushing on this string just a little bit further, there are so many single asset development companies out there right now, all around the world. All the economics look a whole lot better in the precious metals, in the gold space right now at these current prices. So how far down the food chain is Wheaton willing to go here? What sort of margins are you looking for? And what is your take on this environment here where we just seem to have a dearth of these companies that have an asset that seems like it'll make money? They just need the money to build it.
Yeah, it's especially in the gold space. I mean, the gold cost curve, which is something, whenever we're looking at investing into projects, we do a lot of study about how that project fits within its respective core commodity cost curve. So in the case of investing into a gold mine, we're going to look at the worldwide gold cost curve. And gold's a bit unique right now because, boy, just about every quartile looks incredibly healthy when you look at the spot prices for gold right now. And it's one of the reasons why we've seen so much activity. You look in the copper space, you look in the lead zinc space, it's just not there yet. It needs support. And so our focus has always been trying to stay focused on first quartile and second quartile assets. I think currently about 83% of our production falls into first and second quartile assets. That is, to me, one of the key criteria. And so, you're right, Corey, there's a ton of projects out there looking for support. Our biggest, I wouldn't call it a challenge, but I mean, the thing that we have to be the most careful about is the quality of those assets themselves, making sure that they actually, satisfy our own criteria for quality. And so we are pretty selective about what we invest into. That's usually the limiting factor as to how we can go forward, is just finding good quality assets that deliver those, that you can be confident about good high margins when they get up and running.
Yeah, Randy, so important to have not just solid operators, but a project that has those first and second quartile costs so that you know that they're going to benefit through the ebbs and flows of the commodity cycle. And I think this brings up an interesting point about the business model of Wheaton and being a streaming company is when you deploy capital, you've got a great slide in your deck that talks about the accretive deployment of capital. And when you look at the last decade or two, you've seen a straight up to the right chart where the capital deployed has had such a fantastic return for investors. So maybe just speak to that as an underpinning part of the business model.
Well, and it really does come down to investing into good long life assets. And as you started off saying, having a high margin asset means it'll survive the ebbs and flows of the market. But there's actually, Chad, there's another advantage to this, and it's the first place that our partners reinvest into. And it didn't get mentioned at the start of this, but I'm a geological engineer, and so I'm a closet geologist. I love that aspect of it. And one of the things that I'm most impressed, and I think it's probably buried back in the appendix, but in our investor deck, but it's the exploration success that we've had. And we've just celebrated our 20-year. This is our 21st year of operations. We started this company back in 2004. And do you know that our net consumption of reserves and high confidence resources, which is measured and indicated, not inferred, but measured and indicated, our net consumption is maybe somewhere around 1 million ounces total over 21 years, because exploration success has essentially replaced pretty well every ounce that we've actually mined. And that's because these are high margin assets. And so not only do they survive the ebbs and flows of the market space, but they're also the first place that our partners go back and reinvest into exploration dollars, expansion capital, expansion studies going forward. And there's so many examples of that within our existing portfolio about how they go back and continue to improve because they're also generating significant revenue from that. So it is a real key benefit in terms of being selective on those assets and getting that benefit.
So how about jurisdictions? And Randy, you talk all about this high margin aspect that you're looking for, but some of the highest margin projects and assets are in somewhat lower tier jurisdictions. So you've even done some deals in the past few years in Africa. Your core area, still very much the Americas, but any new jurisdictions that you're looking at for potential diversification?
Well, jurisdiction, a lot of that can be managed through proper structure, right? Our approach has always been, really, it's about a 4-level approach, right? We latch into security at the asset level, we put restrictions on the operating subsidiary, and we look for a parent guarantee. And then the 4th level is that we are very, very active in investing into the local communities around the mine sites to help strengthen our operating partners' social license. And that 4th one is a pretty key one. And so as I like to remind a lot of companies that approach us, they're looking for a structure where they can stream off some of the political risk, and that's not our business. We'll leave that to our peers who are showing a better aptitude of being diversified and streaming political risk. We do not stream political risk. We stream gold, we stream silver. And so, what we look for is protections so that our shareholders won't lose as a result. Now, if something happens like what we've seen in Central America here in Panama of recent, we would get our money back. Our contracts will all have provisions that would allow us to get our money back from the actual entity itself if we so choose, or we could ride the thing out. But to have that choice is incredibly important in terms of managing political risk. I've always felt political risk needs to stay with the operator. They're the ones that manage it. It is very tough to actually forecast political risk. And so make sure you structure the contracts such that as much of the political risk is left with the operator as possible. And I think that's the key thing. Now, from a jurisdictional perspective, Yeah, we've expanded into Africa over the last couple of years. Three exciting transactions in Africa. Africa produces more gold than any other country or any other continent in the world. And there are definitely jurisdictions in Africa that I would rate higher than other, even South American or Central American jurisdictions. And so it really does come down to, focusing on trying to understand the country that you're investing into. But I would add also the community that you're investing into. You really need to step back and have a good feel when you're doing the due diligence about community risk also, because quite often we see it's the communities that ultimately wind up with the final say. It is their backyard, and so I'm not going to argue that point, but we want to make sure you have that support. And so we put a lot of effort into that side, and I think combined due diligence along with a structure that protects our shareholders, we've really been able to minimize our exposure to political risk.
Yeah, some great thoughts there, Randy, on getting the social license, but also having the right kind of contracts in place that give you the flexibility if something like that does come up, like what happened in Panama, but also knowing on the front end that you've got the right operator with the right social license and the right project. I guess just as we look at the environment we're in, just to kind of widen the scope a little bit, Randy, we just saw an amazing Q4 for most companies. Obviously, Q1 getting numbers coming out soon for most companies, yours included. I know you don't have the numbers out yet, but you've prided yourself as a company and really excelled at revenue generation. I would imagine with the gold price and the silver price being even higher in Q1, we're going to have higher revenues. And it looks like that trend is continuing so far into Q2. What can you say in a general sense about how Q1 shaped up for the company from a big picture standpoint?
Well, it's a growth year. We will see higher production towards the end of the year just because we have a number of new mines coming on stream over the course of the year. And so, I think the guidance we've sort of given is something like 45 to 48% of the production in the first half of the year, and then the 52 to 55% in the second half of the year. So we will see growth over the course of the year itself. Salobo really hit it out of the park in the fourth quarter of last year. The asset has got excellent, from an operating perspective, it's doing very well. And so we expect to see continued performance, if not outperformance from that one, without getting too much into detail for numbers that haven't been released yet. It's shaping up to be a good year. A combination of commodity prices and some good strong assets and some exciting startups. And so, stay tuned. The nice thing I like about, the way we're setting up here at Wheaton is that maybe not on a quarterly basis, there'll be a little bit of volatility on a quarterly basis, but I can be very sure that over the next year, every year, there's going to be a substantive step up from the year prior just because of the diversified number of assets. We're adding 9 new mines over the next 4 years. And so it's not just one asset that we're riding on. We've got such a diverse growth profile coming forward. And like I said, it's always been my objective to get our company up to 1 million gold equivalent ounces a year, and we're on track for that now. So really exciting.
Okay, so growth on the horizon, continued growth over the next few years. Now, Randy, because Wheaton is really one of the big boys in the sector here, I want to talk to you about what you're hearing from investors, because recently we have gotten a lot of very positive data out of different fund managers, different surveys that shows that even the Western world is waking up to this gold move. We can see by just how much money has flowed into some of these gold-backed ETFs, but we do keep hearing that even something like GDX has had some outflows, even though the stocks have outperformed gold. What have you been hearing as one of the major companies in this sector? So it is where more generalist investors would come first. What are you hearing on the street of generalist investors' interest in the precious metal sector?
Well, we've had a pretty aggressive marketing campaign getting out to meet with definitely all of our major shareholders and trying to also meet with a bunch of new shareholders. And that's what I think the key thing that I would highlight as a differentiator is that, over the last 3-4 months, we're seeing a lot of new faces. Now, a lot of them are just exploring it, but Wheaton represents a perfect way to dip your toe in the water. Very, very low risk. As I like to advertise, we're never going to make anyone look stupid because we've got such strong contracts in place with strong assets. This is an excellent way for someone to explore the precious metal space. And we're getting, definitely the appetites. Not only are we seeing new funds and going to new conferences, but even with the existing funds that are major shareholders of us, when you come into their boardroom, and now we've got 6 or 7 different fund managers there versus the traditional 1 or 2 gold bulls that have been there all the way along. We're getting larger groups with a broader broader section of fund managers coming in. So we're definitely seeing that increase in appetite and interest level. I don't think it's quite reflected yet. One of the areas that we're actually getting quite a few questions on is our silver exposure. 40% or close to 40% of our revenue comes from silver, which makes us, I hate to say it, one of the biggest silver and one of the more silver-rich companies out there, even more so than most of the companies that have silver in their name. And so, and again, that silver is produced at an incredibly low cash cost per ounce of, somewhere around $5 per ounce. And so, we're getting a lot of interest in terms of that exposure, trying to understand more about that side. And so, that to me is a sign that Western retail is starting to pick up. If you start to get some interest in the silver space, silver always lags gold, and it doesn't trade as a precious metal until the Western retail market starts investing into it. And the fact that we're getting a lot more questions on the silver side tells me that we are starting to see, an increasing appetite. But what I love so much about precious metals is that even without that, the strength behind gold is so strong right now. The moving factors behind gold, especially if we continue to measure it in US dollars, I just think that there's an incredible opportunity to go forward. We're only seeing the start of this bull market. I'm trying to find long-term negatives, and I can't. There's going to be short-term volatility. There's no doubt that in today's environment, there's a lot of volatility out there on a worldwide, market basis. And I would say that, gold right now is acting as a bit of a comfort metal in that sense, that it's a great place for people to move to when you have extreme volatility and you don't have the appetite for it. So we are still going to see that. I don't see that changing. What I'm excited about is when you add that to a waking up of the Western retail side, equities are starting to strengthen up. The ETFs on a net basis have been gaining over the last few months. That tells me that we are starting to see that come in. What we need to see is some good, strong results from companies like us, and even in the operating space, the mining space. And I think over the next few quarters, you're going to start seeing that with these prices. And hopefully that kind of success will just continue to bring in more investors.
Yeah, you're right. It really just feeds on itself, right? The sector needs to deliver and then need to remind people that they are delivering, showing the share price gains, making people money, right? That draws in even more investors, but we definitely have
An easy
seen...
argument where you can point to all the cash you've got. It's an easy argument.
It is, isn't it? But it really helps when you're mining a commodity and the price is very public and it just keeps moving higher. So it all feeds into, again, what is a very positive environment, especially now for precious metals, gold specifically, but I think also resources in general. Gold can drive a lot of interest into other commodities as well. Randy will wrap it up here. Again, Randy Smallwood, President and CEO of Wheaton Precious Metals. Great having you on the show, Randy. Really appreciate your time today and your insights on the market.
Always a pleasure, Corey. Thank you.